If you want to understand why fortunes are made in software after the panic, you have to stop looking at software as code and start looking at it the way I look at railroads, utilities, insurance, and consumer brands. You have to ask a far more uncomfortable question: who owns the toll road after the market finishes frightening itself? That is the question almost nobody asks during a decline. In the decline, people talk about disruption. They talk about fear. They talk about what might happen 3 years from now. If some miraculous piece of technology wipes out the old leaders in one clean blow. They talk as though large businesses with customers, data, contracts, infrastructure, engineering teams, sales channels, and balance sheets are made of paper. They talk as though the next headline is stronger than the next earnings report. I have lived through enough cycles to know this habit never dies. Every cycle arrives wearing a new costume. First, it is railroads, then radio, then television, then mainframes, then the internet, then cloud, then AI. The costume changes, human nature does not. The market gets intoxicated on the way up and terrified on the way down. In the middle of that emotional swing, prices stop reflecting the difference between a fragile story and a durable machine. That is where real money gets made, when software sold off. Most people explained it with one sentence that sounded intelligent enough to repeat without thinking. AI will disrupt software. That was the phrase neat, modern, efficient. It sounded like analysis, but in most cases it was just panic compressed into jargon. Because the real question was never whether AI would change software. Of course it would. The real question was who would capture the change, and that is where the crowd started using a child's map to navigate an adult battlefield. They acted as though a software company with a global installed base, deep enterprise relationships, embedded workflows, billing power, data gravity, and the ability to absorb new technology would somehow be the natural loser, while the unproven challenger with a model and a dream would be the natural winner. That is not how capitalism usually works. New tools do create new winners, but old platforms with reach and distribution usually absorb the new tool faster than the market expects. That is the first thing I want you to understand. The market was not selling software because the cash registers stopped working. The market was selling software because fear became easier to price than reality. And once fear gets priced hard enough, you no longer need perfection to make money. You just need reality to be less bad than the panic. I do not like making forecasts about fashion. I like diagnosing systems. And the system here is simple. Big software did not break. The market story about big software broke. That is a very different event. When those two things get confused, prices detach from the earning power that will eventually bring them back. The crowd always believes the repricing is wisdom. Often it is exhaustion. Now let me show you the operating system I would use to think through a rebound like this. The first mechanism is what I call fear compression. When an industry gets sold on a narrative rather than on fresh financial deterioration, the decline often becomes much steeper than the actual damage. Businesses with different products, different customer bases, different margins, different capital structures, and different competitive positions all get pushed down together. Because the market wants one clean category to punish. That is emotional efficiency. Not analytical precision, software was hit exactly that way. It did not matter whether a company was building the infrastructure that AI would run on, embedding AI into an existing work, or still years away from proving its economics. The basket got marked down because people wanted out. Once that starts, the market stops asking which business is getting stronger. It asks only which businesses can still be feared. That is when bargains begin. The second mechanism is what I call installed base immunity. People who have never sold anything to a large enterprise imagine that big customers switch mission-critical systems the way teenagers switch apps. That is fantasy. Corporations do not rip out core systems lightly. They do not replace customer records, financial databases, workflow automation, and sales processes because a shiny demo appeared. They change slowly. They test, they integrate, they negotiate, they drag their feet, and all of that inertia, which sounds boring to the crowd, is enormously valuable to the incumbent. If you already sit inside the customer's operating life, AI is not necessarily a threat. It can be an upgrade fee. That is why I pay so much attention to businesses like Oracle and Salesforce, in moments like this. The debate around them was framed as though AI might make them obsolete, but the more plausible outcome was sitting in plain sight. They would use AI to deepen the product, tighten the customer relationship, improve productivity, expand wallet share, and justify new spending. In other words, they would do what good businesses always do when a useful new tool arrives. They would incorporate it. The market temporarily forgot that incumbency with distribution is one of the strongest assets in capitalism. The third mechanism is what I call backlog gravity. When a company is building toward a large demand wave, the market often becomes obsessed with the visible cost before it appreciates the invisible earning power. You see that in manufacturing, you see it in energy, you see it in telecom, and you are seeing it now in the software and AI infrastructure stack. Take Oracle. People saw the debt, they saw the spending, they saw the capital needs behind data centers and infrastructure expansion, and because most market participants are trained to react faster to cost than to compounding, they treated the build-out as danger first and opportunity second. But if the backlog is swelling, if contracted demand is growing faster than the obligations used to support it, then the debt is not the whole story. It is part of the bridge to a much larger stream of revenue. That distinction matters. You can destroy yourself with debt if you are borrowing against fantasy. You can also look temporarily expensive or temporarily messy while you are borrowing against durable demand. Those are not the same thing. One is desperation, the other is capacity. Markets under stress love to confuse them. The fourth mechanism is capacity bottleneck logic. A great many investors talk about AI as if all consequences arrive instantly. They imagine the future landing on the present in one afternoon. But even the most disruptive technology must pass through the real world. It needs chips, power, data centers, engineers, integration layers, enterprise adoption, compliance, workflow adjustment, retraining, and budgets. Capacity constraints slow the timeline. That matters, because time is the ally of strong incumbents. If the people supposedly destined to disrupt the big software platforms still need years of infrastructure and model development before they can attack at scale, then the established firms are not sitting still during that period. They are learning, they are shipping, they are bundling, they are collecting feedback, they are locking themselves in deeper. This is one of the market's great recurring mistakes. It prices the end state immediately and ignores the path required to reach it. But fortunes are made on the path. That is why I treat software rebounds like this. Less as a technology story and more as a timing story. The market panicked as if the terminal outcome had already arrived. The businesses kept operating as if adoption, monetization, and integration would still take time. Time is not neutral in such a mismatch. Time shifts value toward the companies that are already alive, already profitable, already embedded, and already trusted. That brings me to valuation. When fear has done enough damage, valuation stops being a number and starts becoming a spring. I do not mean that every cheap stock rebounds. Many do not. Some are cheap because their future truly has collapsed. But when a high-quality or strategically advantaged business gets priced as though it has already suffered the full punishment before the evidence appears, the compression itself becomes fuel. A company that historically traded at one kind of multiple and now trades at a radically depressed one without a matching collapse in its underlying economic usefulness is not merely cheaper. It is storing pressure. Salesforce is a good example of the logic. This is a company that still sits at the center of customer relationship management for major businesses. It has scale, it has relevance, it has a visible place in enterprise workflows, it has shown productivity gains and customer traction tied to AI. Yet the stock got treated as though its future had become deeply impaired. Meanwhile, the business was still producing earnings, still generating cash, and still buying back stock. That matters to me. When a business reduces share count aggressively, while the market refuses to credit its staying power, you can create powerful upside if sentiment finally reconnects with economics. I have spent much of my life telling people that price is what you pay and value is what you get. In software panics, that old line becomes almost painfully literal. People see a falling quote and infer falling value. Sometimes they should. Often they are just watching falling confidence. Those are two very different experiences disguised as one chart. Now let me say something harder. because not every name in a rebound deserves the same confidence. The market also throws speculative names into the same wash, and here discipline matters. SoundHound is interesting for exactly the opposite reason Oracle and Salesforce are interesting. It does not represent incumbency strength in the same way. It represents optionality. It represents a business with real technology traction, expanding client relationships, and upside if the pathway to profitability becomes visible. But it also represents the survival tax that speculative companies always pay during difficult periods. When a business is still burning cash, the market can punish it much longer and much more violently than believers expect. That does not make the opportunity fake. It makes position sizing and honesty essential. I do not object to speculation when it is named honestly and handled with discipline. What destroys people is pretending a speculative story is the same thing as a cash-producing machine. It is not. One is a bridge to possible scale. The other is already collecting tolls. In a rebound, both can rise. But they do not deserve the same weight in the portfolio or in the mind. That is the fifth mechanism. I call it hierarchy recognition. When the rebound begins, the crowd often wants the most exciting symbol, the biggest possible percentage move, the story that can double the fastest. I understand the temptation, but durable fortunes are rarely built by confusing the outer edge of the risk spectrum with the center of it. The smarter move is to know which holdings are compounding machines, which are optionality bets, and which are merely noise-wearing optimism. If you cannot rank your software names by resilience, monetization power, customer dependence, and financial durability, you do not have a strategy. You have a mood, and moods are expensive. Now, look at what happened the moment software started to rebound. A strong move in Oracle did not require some grand perfect announcement. Buying itself became a signal because the selling had already exhausted so much confidence. That is another thing markets routinely forget. Once price has been driven down by fear long enough, the first sign of persistent demand can start an entirely new conversation. People who were waiting for proof suddenly realize they have been waiting alongside many. Then one buyer leads to another. What looked empty begins to look crowded from the other direction. That is how reversals often begin. Not with certainty, with asymmetry. You do not need every skeptic to become a believer. You need enough sellers to be finished. This is why early investors make fortunes in episodes like this. Not because they possess magic, not because they are reckless, not because they know the future in some mystical way. They make fortunes because they understand something very basic that emotional markets keep trying to hide. The best money is often made when strong businesses are repriced for a future that is too dark, too fast, and too uniform to be true. If you wait until the market feels safe, you will usually pay for the safety with your upside. That does not mean buying blindly. It means learning how to tell the difference between a broken business and a broken narrative. Most people never develop that skill. They outsource it to headlines. A headline can tell you that software is dangerous. It cannot tell you whether Oracle's backlog justifies its build-out, whether Salesforce is using AI to deepen its moat, or whether a smaller name is finally approaching a credible path to profits. Those judgments require work, and the market pays people who are willing to do that work while others are still reacting. This is where the identity flip happens. Most investors think they are choosing stocks. Usually they are choosing which emotion gets to govern them. In a panic, they choose protection and call it prudence. In a rebound, they choose excitement and call it conviction. In both cases, they are often just being led by temperature. What I want for you is different. I want you to stop behaving like a spectator of price and start behaving like an owner of earning power. That is a different identity. Owners ask what the business will look like after the fear burns off. Owners ask whether the customer relationship is deepening or weakening. Owners ask whether new technology is a weapon against the company or a tool in the company's hands. Owners ask whether temporary spending is building enduring capacity. Owners ask whether buybacks at depressed valuations create future leverage. Owners ask whether management is moving toward profitability or merely issuing hopeful language. Owners ask how long the market can stay confused relative to how long the business can keep executing. That is how owners talk. And that is why owners are usually the people who get paid after the rebound. So let me give you the blueprint in plain English. Keep your eyes on 3 layers. These are the businesses already embedded so deeply into enterprise behavior that AI is more likely to become an upsell than an execution order. This is where I put the strongest attention when panic creates discounts. Second, the monetization layer. These are the companies where spending, debt, or infrastructure build-out looks scary on the surface but may be justified by backlog, demand visibility, and pricing power beneath the surface. Here, you must separate reckless expansion from strategic capacity. Third, the optionality layer. These are smaller or less proven firms where the upside can be enormous, but only if the path to profitability stops being a dream and becomes visible enough for institutions and analysts to treat it seriously. If you mix these layers together, you will make bad decisions. If you understand them, you can build an intelligent response to the rebound instead of a frantic one. Because the market is now moving into the part of the cycle where excuses get tested against reports. Software can no longer live only inside fear. Earnings are coming, guidance is coming, demand evidence is coming, pricing evidence is coming, margin evidence is coming. And once numbers return to the center of the stage, the stocks that fell mostly on narrative compression can recover with much more force than the crowd expects. That recovery may not happen in one day. It may take months, it may take quarters. I do not care. Time is not my enemy when I am buying something whose earning power is improving, while the market is still trying to decide whether to forgive it. That is how patience becomes an advantage rather than a slogan. Now, I want to end where most people should begin. The last time software acted like this, the market was not giving you a gift wrapped in certainty. It was giving you a test wrapped in discomfort. That is always the contract. You do not get extraordinary upside in exchange for comfort. You get it in exchange for discipline, selectivity, and the willingness to stand inside temporary ambiguity without losing your mind. Early investors make fortunes not because the path is obvious, but because they know what to measure while everyone else is measuring mood. So here is the final test. When you look at a battered software stock, are you looking at a machine that is learning to convert a new technological wave into contracts, cash flow, and customer dependence? Or are you looking at a story that still has not earned the right to survive? If you cannot answer that, do not buy. If you can answer it, and the price still reflects panic rather than earning power, then the market may be handing you exactly what it hands the patient every few years, a chance to buy the toll road while the crowd is still arguing about the weather. That is not excitement, that is business. And business, when bought at the right price with the right understanding, is how fortunes are made. Let me take that one step further, because rebounds do not live on philosophy alone. They need proof points, and software is entering the exact stretch of road where proof begins to matter more than narrative. Earnings season is that moment. When fear dominates a sector, people speak in sweeping abstractions. When earnings arrive, abstraction gets cornered by specifics. Revenue either accelerated or it did not. Backlog either expanded or it did not. Margins either stabilized or they did not. Customers either renewed, expanded, and bought more or they did not. The reason I like moments like this is that they force the market to stop arguing with itself in the dark. If Oracle keeps showing that spending on infrastructure is tied to swelling demand, then the conversation changes. If Salesforce keeps showing that AI is improving utility rather than cannibalizing relevance, then the conversation changes. If a smaller name like SoundHound can finally make the path to profitability less theoretical and more visible, then the conversation changes there too. And when the conversation changes after a long decline, price can move much faster than fundamentals, because the fundamentals were never the whole reason price went down in the first place. Fear was. That is why I always tell people to separate catalyst from cause. The cause of the opportunity is the disconnect between price and business reality. The catalyst is simply the moment the market is forced to notice. Those are not. If you confuse them, you end up believing the opportunity begins when the earnings release comes out. Usually the opportunity began much earlier, in the period when fear was still doing the heavy lifting and nobody wanted to look patient in public. That is another costly habit of modern investors. They want to be seen buying strength and never seen buying discomfort. But the market rarely hands out oversized returns to people who insist on emotional applause before acting. So I would build a protocol here. I would not chase every green candle as if it were salvation. I would not dismiss every rebound as a trap, simply because the chart still looks bruised. I would ask, company by company, whether the business is converting AI from a headline into a billing event. That is the whole game. Can this company turn adoption into contracts? Can it turn contracts into recurring revenue? Can it turn revenue into cash flow? Can it turn cash flow into either reinvestment, repurchases, or durable strategic control? If the answer keeps getting stronger while the valuation still reflects fear, that is where I lean in. If the answer is still vague, promotional, or dependent on capital markets generosity, that is where I stay humble. People think discipline is mostly about saying no. In investing, discipline is often about knowing how to say yes in different sizes. A giant installed base with real cash generation can deserve one kind of confidence. A speculative name with improving traction, but no clean profitability path, deserves another. That is not inconsistency. That is intelligence. And intelligence in markets often looks less like brilliance than like proportion. The crowd almost always loses proportion near turning points. They hated software too much on the way down. Then they will love it too easily on the way up. I am not interested in either mood. I am interested in buying business strength during emotional discount windows and then letting time do the part that emotion never can. That is slower than excitement. It is also how serious capital survives long enough to compound.